Hello, my name is Przemysław Kwiecień. I'm Chief Economist of the XTB and you're watching our weekly trading webinar. So let's start, and today we're going to talk about inflation, which is the highest in, as many years as you like, pretty much depending on the measure we're going to use. But anyway, it's high in the US, and we're going to look how it influenced markets last week and what to expect going forward. But before we do that, let's start from top news on the Monday morning. Well, so first of all, markets remain upbeat despite quite scary inflation data. This is something that we will discuss in a minute, but right now the key point is that the markets remain very upbeat despite the bad news. I would say the worst news that we got this year so far. Gold breaking above 1850 for the first time since early February, as the FOMC remains ignorant to inflation risk. Let's take a look at gold prices. As you can see, the first reaction to, well, even before that, and gold was well set for this rebound after retesting this 1680 support line twice. And yeah, this recovery was well deserved, and with the stabilization on the interest rate front, it was supported with slightly lower treasury yields, and we saw a quite rapid acceleration here. So ahead of inflation report, which was here, markets were already quite the gold price rebound was already quite mature, so many market participants could expect, okay, so if inflation is high, then probably could be the end of this move. And it looked like this initially. As you can see, this big red bar here is the first reaction to the inflation that we got last Wednesday, because bond yields also increased quite dramatically. But then, as you can see, we have a reversal on both markets, as the Fed members said, look, we still expect this inflation to be temporary, and we are not going to react. So obviously, with inflation rising and with the monetary policy not adjusting, this is obviously positive for prices of precious metals, and therefore gold is gaining. And this comparison to this move from late 2020, early 2021 is probably the only warning factor right now that this market is quite overbought in the short term. But for as long as bond yields are so much supportive as they've been recently, it looks like gold can climb even higher in the short term. So good fortune for gold prices. And let's move on. Weak retail sales data from China. Obviously, it's still a big increase from the previous year, but obviously last April was still heavily affected by lockdowns even in China. So big rebound was expected, and the fact that that the rebound was smaller was kind of disappointment. And Bloomberg wrote that, look, it's actually a good news, because maybe authorities might increase the stimulus. So obviously this just shows us how crazy markets are today. The weak data is actually good data, because there is going to be more stimulus, and markets are going to rise in the short term, no matter what the consequences are. So the data from China, where the stimulus is far less of what we have in the US or even in Europe, is already showing that the economy might not necessarily be that strong. Elon Musk is a very famous guy in the crypto community these days, and he hit the market once again, suggesting that Tesla could actually drop those bitcoins that they bought before. Now, emission rights in the EU are soaring. Nearly 9% last week, 26% last month. Let's take a look at the chart. This actually looks like another crypto instrument. So we are yet to see if Brussels achieves any climate goals with this, but what they achieved, they actually created a great speculative instrument. So as you can see here, it looks like a bubble. It probably is. You can see obviously prices tumbled during the peak of the market crash in March of 2020, but then they recovered pretty quickly, and they struggled until the end of October. So here we had the second wave, but then there were vaccines and everyone became optimistic about the recovery, and as you can see, these prices soared much more than any equity market index. So even if at the beginning it could be like it's fundamental recovery, then for now it's definitely speculation. So sooner or later it's going to crash, but for now obviously it's rising at the very good rate, so worth keeping an eye on. And finally, Middle East tensions with little market impact so far. So let's turn to the data. As you can see already here on this chart, inflation expectations, not only inflation but also inflation expectations are on the rise in the US, and this is going to be very strong topic, despite the Fed confirming, despite the Fed suggesting, look, we are not going to change our narrative, markets are going to test them because the data suggests so. If you look at the retail sales, that was also the important figure last week, it was actually a bit weaker than anticipated, but that doesn't mean that demand is weak in the US. The black line is what the demand would be if it increased at the average rate from 2018 and 19. So you can see it will be here and here, whereas with all the stimulus it's actually way higher. So even if the 1 month data is slightly weaker, it doesn't really change the picture. So the demand is strong and companies are able to rise prices, and they do. So if you look at the inflation in the US, as I said, depending which measure you choose, you are the highest in the number of years that varies, but anyway it's large. The green line, which is core CPI, is maybe a little bit hidden here, but it's over here and it's the highest since the mid of the 90s. And what it means, so first of all, let's take a look at the what drives inflation. So obviously the Fed is right to point out that it's to a significant extent the base effect of fuel prices, which is the violet part of the bar, and it's going to disappear over time for sure. Not in May, it might be actually even slightly larger, and in May alone inflation in US might be close to 5%, but over a longer term it's going to disappear, or at least it will be much smaller. However, take a look that many other parts of the bar are increasing as well. Let's take a look at apparel, which declined for many months. Even before the pandemic, it was always negative because you had cheap imports from China and Asia, but right now it's actually positive. Look at recreation, which was before the pandemic it was flat. It was like non-existent. Then it started to become positive as the first reopening in the US started to emerge, and right now it's rising very quickly, and I expect it to continue to contribute more and more to inflation, because obviously people will want to go out, and companies with the limited competition in services sector, because some companies went bankrupt, they will have more pricing power. So if you look across the categories, actually once this obviously will decline over time, the other parts of inflation are very likely to keep contributing more. Not maybe not to the extent that inflation is going to stay at 4%, but it might simply not drop to 2% permanently, but it actually might remain elevated. So this is the risk, and if so, what are the consequences for the stock market? So first of all, let's take a look at the comparison of level of inflation and the next year of S&P 500 returns. As you can see, there are no conclusions here. It's completely random. So you could say, okay, the inflation is irrelevant for stock markets, but it's not exactly the case. Here you can see the change in annual inflation and 5-year returns are again quite random, but at least you can see that here are no dots. It means that if inflation is accelerating quickly, then the next 5 years might not simply bring a really strong bull market, because if 5-year return is above 100%, it means that there is consistent strong rally over many years. So as you can see, with increase of inflation, annual inflation above 2%, the likelihood of such a strong durable bull market is not here. So this is the first consequence that we already see. But more importantly, you can see a very strong relationship between valuations. You have Shiller price to earnings on the left and forward price to earnings on the right, but you can see the picture is pretty much the same, and bond yields on the x-axis. So as you can see, as bond yields increase, valuations drop, and that makes sense, because if bond yields are high, then it's less people want to invest in stocks because they can get good interest on the market, and also valuations decline because future earnings are when you discount them to the present value are worth less. So here this relationship is pretty strong. And then you can also see that historically higher inflation is very positively correlated with bond yields. So high inflation should provoke higher bond yields and lower valuations, which you can see on this chart. Again, this relationship is pretty strong. Obviously it's not linear, it's more like this shaped, like L or something like this, where at inflation which is low and stable around 2%, these valuations are can be quite random. They can be high or they can be lower, but as you can see, as inflation increases, then these valuations drop pretty quickly, at least historically. The problem is right now that these dots where we are right now are quite separated from the typical relationship because of the Fed, because they are printing so much and because they are resisting any challenge to their view. So if they are right, obviously, and inflation declines, then we are going to stay at high valuations. They will say, look, we are right, we need to print even more, and markets will go even higher. But if they are wrong, you can see then there is nothing on the right, and there is the only direction is here. If their inflation is going to remain elevated above 2%, so perhaps somewhere between 2 and 4, these valuations should eventually come down to this level, and the distance is pretty severe. So yeah, so I would say this is risky strategy. If I was the central banker and if I was objective, not under someone other's supervision, because sometimes I have the impression that the Fed is supervised by some shadow committee that tells them what to do, then I would say, look, maybe I believe the inflation is temporary, but all the signs from the past 2 months suggest otherwise. So just to be on the safe side, I start preparing markets that, look, maybe I might need to withdraw a little bit of this monetary accommodation. That would be the prudent thing to do, and you would think central bankers should be prudent, but they are clearly not. So we are looking at markets where for now short-term markets are happy, because, well, they say, look, if we are getting all of this printing and the Fed doesn't want to change the policy, why not to continue the bull market? And they do. So if you look at the S&P 500, they more than erased this first reaction to this bad data. Like I said, the worst news that we got this year, because if the markets are so dependent on monetary policy, then the rise in inflation is the worst news that you can ever get So you could think this first reaction was completely understandable, but then as I said, because of this Fed, resistance to any kind of suggestion that they could be wrong, we got this recovery, and also on the tech stocks, US 100 rebounded perfectly from this line of support, and we are going to see even bigger showdown between the reality and between the monetary policy. The reality seems to suggest that inflation pressure is here, and they say no. So we'll see which one wins. But of course, if inflation scenario actually materializes and this rise in inflation is not temporary, then market consequences can be pretty serious. All right, so let's move on to this week. And yeah, once again, we had the Fed. Even today, we had lots of speeches. Well, you cannot probably expect anything huge, but at least the markets will look into FOMC minutes on Wednesday, because they can hope that there was some discussion on the taper and how this potentially could, when this potentially could happen. Of course, the FOMC meeting, April meeting, was before the inflation release, so I don't think the discussion was heated, but still, this is something the market will look for. Also, we have flash PMI indices on Friday. So here we are going to look if strong recovery is confirmed by high levels of indices, and we also look into inflation pressures at price indices of these PMIs. So these are the two things that are worth looking at this week. We are also going to get housing starts in the US tomorrow. As you can see, this was historically it was the data that often suggested turning points for the market, but right now we are not there. This market recovered. Actually, it still recovers from this huge crash 12 years ago, 13 years ago. On the nominal level, it's above average already, but it's not as overheated as it was before GFC or in the 80s or in the 70s here. So actually it is one of the very few measures that is not overheated right now, or at least not as much as the other ones. Yeah, and that's it, ladies and gentlemen. Thank you for your time. Please stay with us in the news section of Xstation Mobile platforms. Have a great week. We see each other next Monday.